Good afternoon, everybody. So angel investing is really kind of the new source of capital. It's the new VC, or it's the way where people go in order to find money and the way to kind of build their businesses. What I'm here to do today is hopefully get you to understand why the role of education is important before you start making your angel investments. Let me see if I got my clicker right. Okay, not working on the clicker, so if somebody can help me in that front, please. Got it. Thank you. So this is a little bit jumpy. So let me just give you an overview of what I'm going to cover today. First of all, I want to do a sector definition because there's sometimes a confusion around what is angel investing versus venture capital. I want to try and understand a little bit about the construct of angel investing. I'll then talk about some of the risks involved. And then really the thesis of this presentation is why education is so important for angel investors to consider before they start making investments. And then I'll do a little bit of kind of gazing down the road and help you understand what's coming next. In terms of early stage investing, let's try and look at the landscape. The kind of valley of death, or the area where typically companies fail and where they start to receive their first amount of pre-seed and seed investing from angels, friends, families, and fools, and the kind of seed capital around. And that's a fairly well-known environment now in the world of angel investing. We know beyond that you get into the more complex stages of your A, B, C, even D rounds of funding, kind of referred to as the early stage and the late stage, where some of the venture capital players come into the space, and then even further down the line where mergers, acquisitions, and even private equity players come into the space. This kind of valley of death is not always related to the kind of break-even scenario, but it's typically where most companies stumble, and that's really where angel investors have to focus their capabilities, their insights, their experience, their knowledge, in order to try and figure out which investments they should be making. There are plenty of entrepreneurs out there that are looking for capital, and there are plenty of really poor businesses. So the trick is, how do you try and identify which is a great business, which has got the best potential, and where you should put your money? Last year in the US, in 2016, there were 2,000 companies funded by venture capital firms, and there were about 65,000 funded by angel investing. So really, as this world of disruption is taking place, the financing of these companies is going through its own disruption. The way the companies were typically bootstrapped by friends and family has now been replaced by kind of this institutionalized asset class called angel investing. When companies finally get to the stage, ideally they end up in an IPO, an acquisition, or just grown to be great companies, but that's kind of the landscape that we typically see companies going through. Often people say to me, what's the difference between an angel investor and a venture capitalist? The first thing is an angel investor is an individual. They often are successful business people, and therefore they have their own capital to spend. And that's really a key differentiator, is they're not taking money from somebody else. They're investing their own capital. On average, they invest 10 to 100,000 euros per annum. And per round, the complete round, which may be syndicated between a number of angel investors, could be the sort of 50,000 euros to maybe €1 million, depending on the size of the company, the sector of the company. We know that some biotech and sort of pharma companies require a lot more capital up front, given the road they need to travel before they can get regulated and the way that they start to charge their revenues. Venture capitalists, as we know, are typically spending other people's money. Yes, some of them are forced to co-invest, but they really do it through a fund. They look at companies that are slightly further down the line and companies that are looking for a bigger quantum once they have a proven business model. And they typically stand for slightly longer than an angel investor may stay in. The structure of angel investing, I think a number of us have heard about angel groups. Really, angel groups are a more intimate meeting environment where people meet face-to-face. Yes, they do some virtual stuff, but it's predominantly people who live within a closer proximity, closer geography, and get together. Crowdfunding, as a number of you will know, is very much a higher volume game. The ticket size per investor is typically smaller, and the scale, the number of opportunities to invest is significant. Typically, and again, this is not always the case, crowdfunding is really each man for himself. Whereas angel groups, you have a collaborative approach. People are able to do due diligence together. They can work on the meeting the entrepreneurs. They can look at the company more tightly. Crowdfunding often has maybe some kind of leaders that people will follow, but typically it's you in front of your PC trying to figure out which is a good investment or not. Where we sit as a company at Go Beyond, we kind of sit as a hybrid in between. We employ some of the elements of a fintech company to make sure that we can kind of increase the flow of deals, but we really like the intimacy. We like people to meet, we like people to communicate, and we really like them to get to know the entrepreneurs and hear one another's views. How big is angel investing? As I said to you, in the figures for 2016 in the US largely is kind of indicative of about a $20 billion industry in the US with around about 350 to 400,000 angels. Sounds like a big figure, but in terms of the US population, you're still looking at about 0.1% of the population that are really successful in their own right. They have capital to spend, and they see this as a way to diversify their portfolio, chase a bit more of that alpha, but then taking on more beta in terms of the risk that they're taking on board. And in Europe, playing a bit of catch-up, and I've heard some of the discussions earlier today around this notion of failure and how kind of there's some cultural differences between the way Europe views startups versus the US. And as one of the previous speakers mentioned, Silicon Valley really is the home of angel investing, and that's not surprising that the figures are much bigger for the US market. In terms of some of the risk attributes that early stage companies face and why we think education is important, just think about the product. It's typically tech heavy, it's often new, it may be a sort of quantum difference from what you're seeing in the existing marketplace, and just trying to understand the product in and of itself in terms of the manufacture, the design, the scalability, the economics is an area where a lot of risks need to be understood. We know that the marketplace itself is typically new, and that's why these companies are seeing opportunities, entrepreneurs are coming up with ideas, and simply understanding the market the way it is today and the way that market may evolve over time is a very tricky area for angel investors to consider. We know that the team structure and development is one of the essential elements of success. You may have a great founder, you may have a rock star, you may have a serial entrepreneur, but what about the people around that individual? What about the development of that team as it goes from 1 to 3 to 5 to 20? How do you understand those risks? And how do you evaluate which is going to be a great team that you can really back? We know liquidity and funding are really areas that you need to understand. I often use this example, and no disrespect to Goldman Sachs per se, but you might be the best equity analyst at Goldman Sachs. You can evaluate a company perfectly. You can get the right valuation, you understand what they're doing, and now I give you a company with really no P&L, maybe some patents or maybe a prototype, possibly a customer. How do you really understand the liquidity of that business or the funding of that business? It's not easy to come out of a sort of traditional finance model where you can see kind of income statement, GP, expenses, hopefully some profitability, and really understand what that company is going to be doing in the next 3 to 5 years. And then, as we just heard from some of our previous speakers, there are legal issues, there are tax issues, there are regulatory issues, way beyond just the kind of IP and the trademarks and copyrights. There are a bunch of other issues that you should understand before you leap into angel investing. Some of the reasons why we think education is important is just around company detail. Things like how do you value the company, which I've just spoken about. The deal terms that you should include in a term sheet so that it's a fair transaction between the different parties. We know the 3 F's are essential: the financials, the forecasting, the funding. A lot of early stage companies are using Excel if they've progressed from the back of an envelope. They simply don't really have the tools or the capabilities for you as an investor to actually go look at 5-year historical audited financials and build your understanding as to what the company is going to be doing and therefore come to valuation. I've mentioned team and founder dynamics, particularly where there are 2 or 3 founders. What's going to happen with that team? How's that going to play out as the company gets capital and grows? And then finally, disclosure. Who knows what? You may put in representation warranties into your term sheet, but really, what do those mean in an early stage companies, and how can you be sure that you're covering your investment so that you're not just putting your money down the drain? We know from market insights, again, immature evolving markets are very difficult to predict. We heard a little bit earlier about Airbnb. Who would have thought that you could have rented a room in someone's apartment? You could have rented a couple of rooms. You could have got a shared bathroom. We all had hotel rooms, or we had like kind of staying with friends. Nobody really conceptualized this concept of a new market that could actually come into existence. The role of technology can never be understated. Every company now is a technology company. If you're in a bricks and mortar business, we know that technology comes into play and needs to be understood. Rate of change is fundamental. We all feel that this world is moving very quickly, but how can we be sure that we understand that rate of change so that we can protect our investment? And then kind of the cliche, but there may be a gap in a market, but is there a market in that gap? Are the economics sufficient that a company who's seen a gap in the market can actually demonstrate that there's a business and an opportunity for them to take your money and really go and make something out of it? And then understanding the leader-follower dynamic. As one of the expressions goes, the pioneers get the arrows and the settlers get the land. In certain industries, that's true. Sometimes it's maybe better to back the second entrant or the third entrant and let the pioneers go and take the arrows, let them take the hits before you jump in and back somebody in that sector with your hard-earned money. And then finally, just from a pure investor perspective, forget all the opportunities that are out there. Which investments do you make? Which ones don't you make? And how do you build a portfolio? Angel investing is not about a silver bullet strategy. It's highly unlikely and statistically very improbable that you will pick that one unicorn that'll make you tons of money. You need to build a portfolio, and in order to build a portfolio, you've got to decide how much risk do you want to take with each individual company vis-a-vis your whole portfolio. How do you negotiate exits? How do you negotiate follow rounds, particularly down rounds? We think that there are good capabilities to learn the skills. So when it comes to a down round, there's certain principles that you can apply. Again, so you don't smother the entrepreneur and kind of disincentivize them, but how do you then kind of build your portfolio and manage your risks from an individual perspective? And then the final point we all need to consider is sector and country risks from your own portfolio. In terms of education, whether it's done online, whether it's webinars, whether it's through certification and training, there are a bunch of different areas that you need to think about, from valuation, deal terms, due diligence, impact investing, and some of the areas that make this a very complex science with part art. Personally, I think there's going to be scope for a lot more certification and training for angel investors, and as a company, we certainly advocate that, and we like people to go through some training before they start making investments. So the final point that I want to make is, as we look down the road to angel investing, which is becoming this asset class, and increasing the quantum of capital that is going towards these startups and helping them grow, what's likely to change? I think the first thing is that more people are going to become angel investors. More people are saying, well, here's my portfolio. I've got stocks, I've got bonds, I've got property, I've got cash. Well, actually, maybe 2 to 5% could go to a slightly more risky environment. My motivation might be altruistic. I've made money in the construction sector, or I've made money in the telecom sector, and therefore want to put money back in that sector. In parallel, we see people who really like certain sectors because they understand the economics. They made money in that sector, and they want to put their money there. Second of all, I think you may see institutions, certainly the online institutions are starting now, but the bricks and mortar universities offering training and accreditation and certification, so that you may take a module which includes all the different elements of angel investing. From understanding the company, to the marketing, to understanding the HR side. And I think some of that will become more institutionalized down the line. And then finally, I think the kind of syndication, the ability for this to become part of people's portfolios is going to grow in percentage as you can start to minimize the risks and hopefully get some education before you leap into angel investing. So that's it from me. Thank you for your time, and it's a pleasure to be at ZEST 2017.